Joining us now to discuss the morphine drip and its implications for the banking system is Bill Cohan himself. He's the author of House of Cards and The Last Tycoons, Chronicles of Wall Street's Highs and Lows. Bill was an investment banker for 17 years at Lazard and J.P. Morgan. Bill, thank you for coming back and joining us once again. Let's talk about the morphine drip. It goes beyond, of course, these support programs still in place. But what are the implications for the banks themselves? You have Jamie Dimon writing these Dear Timmy letters to Tim Geithner, effectively mocking the bailout process, yet J.P. Morgan, Goldman Sachs, all these banks still benefiting tremendously from existing government programs. What do we make of all that?
Well, the first thing that they're benefiting from, Eric, is the low cost of money. And basically, the jet fuel is free for these banks. As I like to say, the airlines could make money if the jet fuel were free, too. The Fed is charging these banks virtually nothing, and then they're lending it out at high interest rates. The spread, based on that spread, they're making a lot of money. So that's point number one. Point number two is all of these programs that exist are, it's hard to criticize them in that, yes, there has been new issuance of asset-backed securities thanks to, say, the TALF program, okay? Which, it's hard to criticize that because that market was completely shut down. And now, thanks to this basically trillion-dollar giveaway of funds that has encouraged new investors to come into that market where they weren't before, that business is beginning to unglue a little bit. But that's different than, relying on market-based activities to revive certain businesses as opposed to stimulating it with government money. It seems to me if you as I say, if you got the morphine drip in there, we all feel good, but that's not the same as an actual market or a business line reviving on its own based on sellers and buyers coming into the market again of their own accord.
That does raise questions, though, about where we would be if this low-cost financing were not available. Tim Geithner, I believe, is on the record as saying that banks need to be profitable again for the financial system to stabilize. So, in principle, is there anything wrong with lending to them at below-market interest rates, or does it just have to be for a certain period of time? Maybe that period of time should have been over by now.
Well, 6 months ago, everybody would have agreed that the system was badly broken and needed something to help it recover. One strain of thinking would have been to let it recover on its own. You've got Bernanke, who wrote a book about what went wrong during the Great Depression and how the Fed chairman then did not stimulate the economy enough, did not provide enough liquidity. And so he's not going to do that. So he's taken this other approach, which is what I call the sort of kitchen sink approach, where every idea that they can think of is being thrown out there to see what happens. At some point, I believe, for a real recovery to take hold in these financial markets, you need to let the markets recover on their own. Take out the morphine drip and let these business lines see if they can really stand alone in the market.
Not to overemphasize this metaphor, but if we leave the drip plugged in and revive these patients once they're restored to health, are we really just returning to the status quo?
Well, there's no question that, by banks, Goldman Sachs, Morgan Stanley, J.P. Morgan repaying the TARP money as rapidly as they have now, that their goal is to return to the status quo as quickly as possible. They want to be free as much as they can. They're not going to be free of all government regulation and oversight, nor should they be, especially since they're bank holding companies now. But they want to be free of the important criteria that they think are going to keep them down, which is this compensation oversight. And now they're free of that now, and now they can do what they want, which I think is a mistake.
All right, Bill, so let's sit tight because we're going to come back with you, talk to you about what that freedom means in terms of compensation. So just sit tight. We'll be back in a second. We're back now with former investment banker and author William Cohan. We're talking about the morphine drip, Wall Street on continued financial support. Bill, obviously this has implications for compensation, especially getting out from underneath TARP as J.P. Morgan, Goldman Sachs did yesterday. And Morgan Stanley, I should add. I had a conversation last week with James Gorman, the co-president of Morgan Stanley. I want to roll a clip from that and then have a conversation about it. So let's listen in. James Gorman, co-president of Morgan Stanley.
Bonuses will be based upon the performance of the business, and bonuses will have, as I said, the equity component, the clawback component, and will operate under what everybody would consider appropriate and reasonable compensation.
Well, but James, allow me for a moment to say that appropriate and reasonable is exactly the same terms that your firm would have used 2 years ago. So what's appropriate and reasonable today?
Well, I don't know that a lot has changed at Morgan Stanley over the last 2 years. We've become a Fed holding company for sure, but we've always paid our employees based upon the competitive pressures in the marketplace and the job that they're doing. What we've changed now is the mix of compensation from bonus to more salary and the clawback of those compensation payments.
So, Bill, James Gorman says not a lot of Morgan Stanley has changed in the past 2 years and that only now they're changing the mix between bonuses and salary. What does that tell you about how pay is going to be handed out in Wall Street?
Well, first of all, Jim should have played up more the fact that Morgan Stanley has actually been on the cutting edge of this, as incredible as that may be to believe. This clawback provision actually is a good thing in that it creates some modicum of accountability for the behavior of bankers and traders on Wall Street. So if they mess up in the future, there's a provision that allows them to take back the bonuses that they got. And why is that an important thing? See, I hate to be derivative about this and reduce it to the lowest common denominator, but if you look back at the 40 years since Wall Street firms started going public, when they went from private partnerships where they shared liabilities and shared profits to public corporations where the risk was on the shareholders and the benefit went to the employees. And I know this because I spent 17 years on Wall Street, so it's not like I'm a stranger to this, and I got compensated about that. But this, to me, is what has caused this repeating cycle of booms and busts, whether it was, the internet IPO bubble, the crash of '87, the emerging telecom debt crisis, on, and now this mortgage-backed security crisis, because Wall Street is very good at innovating, and then they're very, very good at selling, and they sell, and because they get paid for that with short-term, their bonuses, they get until the bubble inflates and then bursts, and they don't know how to stop it.
Okay, Bill, we're going to have one more question for you, but that is precisely the kind of perspective that we wanted from a man who spent 17 years on Wall Street, also an author exploring the history of Wall Street. We're talking with Bill Cohan, author of House of Cards. We'll be back in 2 minutes after this short break with more for you. We're back now with Bill Cohan, former investment banker at Lazard and J.P. Morgan, currently an author who explores the history and other issues on Wall Street. Bill, question for you. The Obama administration rolled out its regulatory reform plan for Wall Street yesterday. We've been talking about TARP. We've been talking about compensation. How do you expect this legislation, proposed legislation, to change or not the behavior of bankers?
Well, okay, so there's, proposed to be a lot more oversight and regulation. It's not like there wasn't regulation and oversight before, and it's not like Wall Street bankers and traders and executives didn't figure out ways to get around it. So I suspect that there'll be a lot of that going on again, whatever form this legislation ultimately passes in. I mean, there's already griping about this provision to retain 5% of any mortgage-backed securities that you sell to actually have skin in the game. I think basically Wall Street got off a lot easier than they suspected they might have if the Dow wasn't at 8,600 and had been still at 6,500. I think that has made people a little bit more lenient than I think they should be or could have been. I think the key again, Eric, is this changing this compensation system, revamping that, making sure that these top 100 guys at these firms have real skin in the game. That would be long-standing change.
Doesn't look like that's going to happen for now, though.
No, doesn't.
Bill, thank you so much. Bill Cohan, author, former banker, joining us once again here on Bloomberg.